Well, Happy New Year, everyone, and welcome to the January Market Insights. Happy New Year, Gavin. Happy New Year, Rich.
Hey
Happy New
Todd.
Year, everyone.
I'm coming from freezing cold Cleveland, Ohio, where there's a foot of snow and single-digit temperatures. Rich is in balmy Puerto Rico, where it's 85 and sunny. Gavin, you're sharing the same similar weather that I am in Jersey. So winter has kicked in, and it's as I said earlier, it's a old man winter is rearing its head this year. So, but we're here to talk about hot markets. Um, so let's kick it off prior to that, let's get the legal update.
Yeah, we're good. We did that
Oh, we did
one.
that. Okay,
Yeah.
sorry, I missed that
Yeah.
as I was babbling. Let's kind of kick it off as we normally do and recap our December call.
Yeah, sure. As we start the new year, it's not really about finding for us like the next new theme. It's about recognizing the one that's been consistently working behind the scenes, and that's been a weaker US dollar. Back in June of 2025, our market insights issue, which we linked in the PDF this time around, Rich wrote about the international investment position, the idea that U.S. exceptionalism could be challenged, and what we've seen unfold since is that basically, international stocks as a theme in 2026 is now consensus. That was allowed to gain momentum because of a weaker dollar. And so, we've had that view for a while now. Just because it's consensus doesn't mean it's necessarily exhausted or exhausting. It's just, sometimes the realization the market's having that there is a structural shift underway. And so we, don't want to have people think we're dollar bears for the rest of the year. That's not what we do at Park Edge. But for right now, there's enough evidence to allow these themes that have gained momentum because of a weaker dollar to play out to start the year, and then we'll take it from there.
Yeah, and
Rich,
I think
anything to add to that?
yeah, I would, if we go back to the piece that we did in May or June or whatever, was really try to highlight that this could go on for quite a while. So, much of what the administration is doing is looking at trade deficits and saying, if we have a trade deficit with somebody, that must mean they're taking advantage of the US. It's of course more complicated than that. But if you look at kind of the mechanics of it, if we have a trade deficit with somebody, we also have a capital surplus with that nation. They measured the exact same thing. One measurement is goods coming into the US. The flip side of the coin is money going overseas. The money that goes overseas doesn't sit idle. It gets reallocated back into US dollar denominated assets. They may hold some dollars. They'll buy treasuries, they'll buy stocks, real estate, you name it. And the sum total of all these trade deficits for 40 years means there's a sum total of all these capital surpluses each year. The Treasury Department issues a report called the Net International Investment Position, and it basically says foreigners now own 26 trillion more of US assets than Americans own in foreign assets. And that figure's doubled in the last 5 years. So that means the US markets, US assets in general, have been the beneficiaries of an average of $2.5 trillion per year in flows. And given passive investing, the only buy decision, if you're a passive index, is when you get an inflow, you buy. So how much of US performance over the last 5 years has been impacted by 2.5 trillion coming in every year to buy US assets? And if reordering global supply chains, reordering global geopolitical power um, is going to have an impact on these flows. To us, it just, it's a big enough number that's been accumulated over a long enough period of time to think that it's probable that it's going to be a headwind for U.S. assets for quite a while. You're part of our positioning. We're saying we want gold over treasuries. That kind of ties back into that theme. Gavin was mentioning international over domestic, also kind of ties into that theme. So everything is kind of interconnected in global markets. And, the dollar is kind of front and center in terms of, creating dispersion among returns and then flows in terms of assets.
Well, that's a great update, and let's stay with that theme. We don't often talk about currencies on our monthly calls. Most of our clients, or many of our clients, probably don't understand the impact of currencies. So, sticking with that theme for at least as we kick off 26, how will this continue to impact? Where do we see the dollar going? I know we don't try to forecast too far into the future because that's a fool's game. But how do we see this playing out? I think you alluded to how we're allocating. Maybe expound upon that a little bit and let clients know where our thoughts are going as we enter here 26 and out in the first quarter.
Well, I would say that, for us, currencies are more of a signal, than anything. We have invested in certain strategies. We have invested in currencies before, but to us, it's a signal. So we want to see what kind of behavior are global stock markets exhibiting, what kind of behavior is volatility exhibiting, commodities, currencies, global interest rates, credit spreads. We want to be able to look across all that and say, based on the behavior that we're observing each morning, is that most consistent with quad 1, quad 2, quad 3, or quad 4? So it's kind of a real-time measure of determining what regime are we in. And what we're trying to do is just remain in alignment with the current regime. So current regime is still quad 1, it's risk on. We want to be able to see when that changes. And the way we'll see it is to wait for these markets to start changing their behavior. And when they start behaving as if it's a different quadrant, that's going to be our signal to say we need to adjust our allocation. And a lot of times currencies are the first thing that move, and then the rest of global macro catches up. There are other times where currencies are like nothingness. They're not really giving a signal, and it's up to the other markets to kind of determine the, dominant behavior. So from that standpoint, it's like currencies are important to us, but more from a market signal standpoint than, trying to find investable,
Right, owning the
opportunities.
currency. Sure.
Just based on the net international investment position being as big as it is and having grown as much in the last 5 years as it has in the face of very significant, global changes, I would take the under. I would bet it remains under 100. I've seen, analyses from really smart people that I have a lot of respect for, that are saying, we could see 80s. But again, if we got there too fast, it would be very disruptive. I think the more likely outcome is just it's an ongoing headwind. The dollar is going to face an ongoing steady headwind. Imagine walking in a 10-mile-an-hour headwind, right? It's the equivalent of carrying 20 extra pounds around.
Right.
We're just saying the dollar has a persistent headwind. Bonds have a persistent headwind. Gold has a tailwind, and international versus domestic has a tailwind.
Mm-hmm. Well, that's great. That's a great. Gavin, what do you have? Anything to add to that?
Just no, Rich just did it. But that's what we do here every day at Park Edge. So earlier last year, what Rich just said is quantifiably observable. We noticed it happening, and we track it every day. And so from here on in, we don't know. The international investment position, like Rich said, could be a very long-term. Yeah, I could sketch out a scenario where that keeps happening over the next couple of years. But
Right.
we take it one quarter at a time, one day at a time, and we see these things happening. And like I said, enough to let these themes play out to start the year, but knowing that they are now consensus,
Right.
and
And
that's okay.
Todd, you're a fellow old man. You probably can recall in your career times where, you know, growth outperforms value for a
Right.
decade, or value
Right.
outperforms growth for a decade, or domestic over international. This could be one of those environments where, international, uh, I mean, even if it just catches up,
Right.
to domestic, that's going to be, many years in the making. And think about, the firms out there that operate with kind of a static 60-40 buy and hold portfolio. Their current international exposure is going to be based on looking back over the last 30 years, looking at the return, the standard deviation, the
Right.
correlation. They're going to conclude international exposure should be X. They're not looking at any of this other stuff. So what is the only thing that's going to get them to bump their allocation up? It's going to be another year or two of good international
Right.
performance relative to domestic. And then they're going to say, well, hey, should we increase our international allocation by 1%?
Right. 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 It doesn't
And
move the needle.
yeah, Gavin used a great term in the written market insights, reluctant acceptance.
Right.
And I think that's what people are going to reluctantly accept. Hey, international had another good year. Should we bump up our, allocation by 1%, or,
Right.
small increment where ongoing performance differentials just force their hand where they have to keep doing that. In our, the strategies that we operate that have both domestic and international, 50-50 is like the balance that we're using. It should be equal amount, and I don't really see many out there that, are treating it like that.
Right. And if you believe in some type of reversion to the mean type trade, it's been 12 or 13 years the US has dominated. So it wouldn't surprise me to see, just, and not that we would use that as our basis, but it wouldn't surprise me to see, you know, international stocks have a run here for, for some time here. That would not be shocking. So,
Yeah, and
Yeah.
it's also maybe worth noting too, it's one step at a time. So we've said let's overweight international. Some people out there in the financial media will take this and say the US is in trouble. You don't want to own
right.
any US. That's not what we're saying. We're saying have a balance here, take it day by day, quarter by quarter, see what develops over the year. That could play out, but it would take time to play out. It's not going to
Mhm.
take happen, this week. So anyway, I just want to try to provide some balance. So if listeners are thinking, "Oh, I shouldn't own any U.S. stocks," that's not what we're saying.
Right. No, of course. So,
And I
well,
think that
I'm sorry, Rich. Go
it,
on.
it it points out there's a difference in terms of this American exceptionalism thing. Are we talking about the real economy or the stock market? So is it Main Street or Wall Street? Um, and for decades, globalization has put a lot of pressure um, on a lot of jobs, a lot of incomes, a lot of families, but it's been good for Wall Street.
Mhm.
So, you know, if the policies in the name of, restoring that, doesn't mean it's going to be good for the stock market. It could be good for Main Street America,
Mhm.
but that doesn't mean it's going to be good for, Wall Street. Um, so I would just caution someone who, looks at the changes and assumes that's going to be good for the stock market. Um, it may not be bad for it, but it is creating flows that indicate that it could be better for, some alternative assets.
Right. Right. No, and we've I think we did a good job last year and on into this year of, recognizing some of that and allocating, properly. So, well, hey, January's off. We're halfway through January, and great update. Everyone's excited about the new year and new beginnings, and we'll catch up again here in February and see how things play out.
See you, Todd.
All right, sounds good.
All
Have a
right,
good
guys.
day,
Have a
everyone.
great day. Thanks. Thanks, everybody.